If you close your eyes and picture an investor, what do you see? You probably imagine some guy in a tailored suit, surrounded by 6 glowing monitors, aggressively clicking a mouse while yelling into a headset about moving averages, crypto yields, or shorting pork bellies. The financial industry has spent decades and millions of marketing dollars making you believe that investing is a high-speed, high-stress game of 4D chess. They want you to think it requires a genius IQ, a Bloomberg terminal, and an iron stomach. But here is the secret they really do not want you to know. When it comes to growing your wealth over time, the smartest investor in the room is usually the laziest one. In fact, if you have your first $1,000 saved up, and you are terrified of making the wrong move, your absolute best strategy is to do almost nothing at all. Welcome to the Lazy Mastermind's Guide to Investing. Today, we are going to talk about exactly what to do with that first $1,000, how to set it up so you never have to think about it again, and why trying too hard in the stock market is actually the easiest way to lose your money. Let us start with the problem you are probably facing right now. You worked hard for that $1,000. You skipped the impulse buys. You packed your lunch. Or maybe you took on some gig work. And now that money is sitting in a standard checking or savings account. You feel a little proud, as you should, but you also feel this nagging anxiety because everyone on the internet is telling you that inflation is eating your cash alive. So, you download a brokerage app, you open it up, and you are immediately hit with a wall of noise. Ticker symbols flashing red and green, breaking news alerts about interest rates, complex charts that look like heart rate monitors, and a terrifying amount of jargon. It is overwhelming by design. The natural reaction for most normal people is to close the app, leave the money in the savings account, and tell themselves they will figure it out next month. But next month never comes. Here's the perspective shift you need. You do not need to pick the winning horse. You just need to own the entire racetrack. This brings us to the greatest financial invention of the 20th century and the ultimate tool for the lazy mastermind: the index fund. Specifically, a broad market index fund like one that tracks the Standard & Poor's 500, commonly known as the S&P 500. If you have never heard of it, the S&P 500 is simply a list of the 500 largest publicly traded companies in the United States. We are talking about Apple, Microsoft, Amazon, Visa, Johnson & Johnson. The heavyweights. When you buy a single share of an S&P 500 index fund, you are not trying to guess which of those 500 companies will have a good quarter. You are buying a tiny microscopic slice of all 500 of them at the exact same time. If one company goes bankrupt, it drops off the list, and a new successful company takes its place. The fund automatically cleans itself. You do not have to read earnings reports. You do not have to watch financial news networks, and you certainly do not have to time the market. You are simply betting on the overall long-term growth of the American economy. Now, I know what you might be thinking. Theo, that sounds entirely too boring. If it is that simple, why isn't everyone doing it? Why are there thousands of highly paid fund managers on Wall Street if all you have to do is buy an index fund and go take a nap? That is a fantastic question. And the answer is that the financial industry thrives on making things complicated so they can charge you high fees. But the data on this is absolutely brutal for the professionals. Let us look at some real numbers. Every year, S&P Global publishes something called the SPIVA scorecard. It compares the performance of actively managed mutual funds, which are run by highly paid experts in suits picking stocks, against a basic unmanaged index fund. Over a 15-year period, nearly 90% of actively managed large-cap funds actually fail to beat the S&P 500. Let that sink in for a second. 9 out of 10 professionals, whose entire full-time job is to beat the market, end up losing to the lazy index fund. If you want an even more famous example, look at Warren Buffett. In 2007, Buffett made a very public $1 million bet. He challenged the hedge fund industry, the supposed absolute elite of Wall Street, stating that a simple, unmanaged S&P 500 index fund would beat a hand-picked portfolio of their complex hedge funds over a 10-year period. A firm called Protégé Partners took the bet. Over the next decade, which included the massive 2008 financial crisis, the hedge funds generated a net annualized return of just 2.2%. Buffett's lazy S&P 500 index fund generated a return of 7.1%. He completely destroyed them. He won the $1 million, donated it to charity, and proved once and for all that in investing, effort does not equal results. This is the counterintuitive insight that changes everything for beginners. In almost every other area of your life, working harder and tinkering more gets you better results. If you spend more time at the gym, you get stronger. If you study harder, you get better grades. But investing is the rare exception. In investing, the more you tinker, the more you trade, the more you check your phone, the worse you perform. Every time you buy or sell trying to outsmart the market, you risk paying transaction fees, you trigger taxes, and you inevitably let human emotion drive your decisions. You panic and sell when the market drops, and you get greedy and buy when the market is peaking. The lazy mastermind avoids all of this by simply buying the whole market and refusing to look at the screen. So, how do we practically apply this to your first $1,000? Here is the exact step-by-step playbook to becoming a lazy mastermind. Step 1 is to choose a brokerage and open an account. You want a low-cost, reputable brokerage. Vanguard, Fidelity, and Charles Schwab are usually the big three that people talk about. They have been around forever. They are highly regulated. And they offer zero commission trading for standard index funds and exchange-traded funds. Do not use an app that treats investing like a casino game with confetti and push notifications. You want a boring, reliable platform. Step 2 is to transfer your $1,000 from your checking account into this new brokerage account. This will usually take a couple of business days to clear. Once the money arrives, it will sit in what is called a core position or a settlement fund. This is essentially just a holding pen for your cash. A lot of beginners make the tragic mistake of stopping here. They fund the account and think they are invested, but the money is just sitting there in cash. Step 3 is the actual purchase. You are going to log in, search for a ticker symbol that represents the S&P 500, and hit buy. If you are buying an exchange-traded fund, or ETF, the symbols you are looking for are usually VO, SPY, or IVV. They all do the exact same thing, which is track the top 500 companies with incredibly low management fees. When the screen asks you what type of order you want to place, just select a market order. This simply means you want to buy the shares at whatever the current price is right now. Put in your $1,000, click submit, and you are done. You are officially an investor. You now own a piece of the 500 most powerful companies in the country. Step 4 is the hardest part. You have to walk away. Do not check the app tomorrow to see if you made $3. Do not panic next month if the market drops and your $1,000 turns into $950. The stock market is volatile in the short term. It goes up and down based on news, politics, and global events. But over the long term, measured in decades, it has an incredibly consistent upward trajectory. Your only job now is to keep feeding the machine. Whenever you have extra money, whether it is $50, $100, or another $1,000, you just log in, buy more of that exact same index fund, and close the app again. This is how generational wealth is actually built by normal people. It is not built by day trading penny stocks in a basement. It is built by consistent, boring, lazy participation in the growth of the economy. By letting the thousands of employees at Apple and Microsoft wake up every day and work hard to make your portfolio more valuable, while you go live your life. It takes a lot of pressure off your shoulders when you realize you don't have to be a financial genius to win this game. You just have to be patient. You have to be consistent, and you have to be willing to be a little bit lazy. If this perspective helped take some of the fear out of your first investment, consider subscribing to the channel. We talk a lot about the psychology of money here, and how to build wealth without losing your mind in the process. Just a quick reminder before we wrap up, this video is for educational and entertainment purposes only, and is not personalized financial advice. Always do your own research or consult with a professional before making major money decisions. I will see you all in the next one.